Hi, everyone. Welcome to the show and happy Tuesday to everyone joining us today. Here is another live webinar just for you. I'm your host, Olivia Higgins. Now, as we wait for a few more people to join us, here is a video crafted and created just for you. Welcome back, everyone, especially to those who just joined us on this live show. Once again, you're back on another live webinar just for you. And this time it's a great Tuesday, and we're going to learn and go deeper into a particular topic, which is a part 2 of what we have covered before. Once again, you're here with me, Olivia Higgins, and I'd like to remind you that today is all about education, okay? So definitely just follow us and subscribe and make sure that you really be up to date of all these new shows that we have for you, and do not take anything as financial advice, okay? We're here to learn together, we're here to network, and we're here to also get your top questions for our expert today. So definitely type it into the chat. And if you're ready for this live webinar, type in yes in the chat box right now. I'm watching all your questions and we will pick the top ones, okay? So definitely stay tuned, network, and you'll be rewarded with some points for asking your questions. Let's hop right in. Today's topic is an Ask Me Anything, a closer look at Singapore warrants. Now, we're following up from our last live that happened in January this year. And if you remember, and for those, I see some familiar faces down here in the chat box, we covered Warrants 101. But for this part 2, we're going to take a closer look at warrants, and we're going to explore how you can use option trading strategies on warrants, how to estimate price performance or calculate time decay, and also understand, I know a lot of you asked about this, understand on the different types of warrant structures. And we are so glad to explain all this and also to provide their insights today with me. Let's welcome back for part 2 of this series, representing Macquarie Commodities and Global Markets, head of Singapore Warrants, Jamie Chung, everyone. Hi, Jamie. Welcome back.
Hello, Olivia. Hi, everyone from Moomoo. So pleased to be back after 2 months. It felt like 2 months too long. And I think we've had the campaign live with Moomoo on one that encourages investors to, I guess, try out the warrant instrument and stand to win up to $400 when you do so. And I think in the last 2 months since we had that part 1 webinar, we've seen quite a lot of you try out the warrant instrument. And so I'm excited to be back here to help you better understand the product and navigate the current volatility and market movements with warrants.
Thank you for that. And also, we're excited to know your insights and also what you're about to share in terms of education for those tuning in from Macquarie's perspective. Now, let's dive straight in. My first question for you: how does market making work, Jamie?
Thanks for that, Olivia. Well, so first of all, Macquarie is a warrant issuer as well as a market maker in the Singapore market. And what this really means is that when you're trading warrants, slide 4, what you typically see on your trading screen, right, when you use Moomoo, is that you often see a bid price as well as ask price, as well as bid volumes and ask volumes. So as an investor, you are looking to buy on the ask price and sell on the bid price when you're looking to exit, right? And so maybe, in other instruments where there is no presence of a market maker, what you typically could find is yourself in a situation where you're not able to, easily buy on the ask and sell on the bid with sufficient volume. But with the presence of a market maker like Macquarie, what we endeavor to do is to be there to provide both bid and ask prices as well as volumes to facilitate the ease of entry and exit in every warrant that you're trading. And that really is the role of a market maker. And again, if you look at the screen, that means that with any warrant that you pull out, you typically can see more than the first level of bid and ask prices. You can see, the best bid and offer prices, below the existing best bid and offer, etc., etc. Now, slide 5. Our market making hours generally track that of the underlying stocks or the index futures that the warrants follow. And the market making hours are up here on the screen. So typically for a Singapore stock, for example, you find that we are there from the whole period of market open at 9 all the way through to 2 minutes before 5 p.m. Now we pull our quotes 2 minutes before 5 p.m. or before any official closing time of underlying, really so that we can, finish and complete our hedges based on what investors have bought and sold. And again, some people might wonder, hey, so is Macquarie the platform provider from which I trade warrants? So I hope this, dispels that confusion. First of all, Macquarie is the market maker and the issuer, which means that we are your counterparty typically when you trade warrants. But in order to trade warrants, you do it via a Moomoo, for example, as a platform provider, just as you would with shares. Slide 6, in order to see the presence of the market maker and where our market making quotes are at any point during the day, we've got this pretty cool tool known as the Live Matrix. It's available on our website. And what you see here on the screen is essentially a screen capture or the matrix, the live matrix of this warrant here, tracking the decay alongside the decay futures. So this is how you can see, where the market makers are quoting in any warrant that you're interested to trade. Slide 7, I think often people are also wondering, so how exactly does a market maker make money, when you're present in the warrant? I think one of the misconceptions is that since Macquarie is your counterparty, therefore when you buy a warrant for 10 cents and then you sell it back at a loss because you've gotten your view wrong, and selling it back for 8 cents, the 2 cents profit that the 2 cents loss that you have suffered, in fact, goes into the pocket of the market maker. Now, the reality is that when you are trading a warrant, and we are your counterparty, whereby you buy a warrant on an ask and we're selling to you, what typically happens is that when you do that via a call warrant, for example, we would then normally buy the shares or the index futures to hedge this position. Okay, what this means is that if your view was wrong because the share price has gone against you, it's dropped, it's decreased, and you lose money on your call warrant, typically we are also making losses on our hedges. So as much as you think you're selling it back at a 2 cent loss, and that is a 2 cent profit made by Macquarie, in fact, we are also losing on the hedge in the shares, to offset this 2 cent profit that you think we're making. So in essence, then how are we making money really? The answer is in slide 8. Whereby we typically try to sell warrants at the margin above the cost that we are able to hedge at. Well, you can think about this way, with any seller out there in the market, they typically have a cost to bear. Now, what is our cost to bear? In this case, we are buying related and similar options that are listed on the exchange traded options market or the over-the-counter OTC market. And that would be our cost. And what we're essentially hoping to do when we sell warrants is to charge a margin via the implied volatility of the warrant at a higher volatility level than that we're buying the option at. So to give you an example, if you look at the base example in the middle of this chart here, so for example, if the cost of hedging by buying an option in the ETO markets for us is at 20 vol, we're paying 20 vol there. What we have to do in order to make money when we sell this warrant is to charge at a higher margin. In this case, we're probably pricing the warrant at 30 vols. And so this enables us to capture a 10 vol margin when we do sell this warrant. However, options, as you know, the volatility in the options market, it varies and it changes from time to time. And when, things get extremely volatile and you see the VIX, the fear index, shooting higher, what this typically means is that the options on the exchange traded option market also generally goes up. So in this case, our cost maybe would have doubled from 20 vol to about 40% vol. And what this means is that if we kept the volatility of our warrants unchanged at 30% vol, we are in fact making a loss because we're buying or hedging it at 40 vol, we're paying 40 vol, but we're selling to you at 30 vol. So in such instances, we will have to increase the volatility level or the price level of the warrant so that, we are not selling at a lower vol level compared to where we're buying it. Okay, and likewise, when the volatility level on the exchange traded option market falls, in this case from 20% vol to 10 vol, what you typically find is that the issuer or the market maker would also adjust the price of the warrant downward by decreasing the volatility level so that we're not charging, an extremely fat margin. And then finally, another way that a market maker could make money via the selling of warrants is on slide 9 via this thing called the holding cost of warrants. Okay, every financial instrument in the market will have a holding cost, but in the case of warrants, it's known as time decay. And what this means is that the warrant value will decrease with time. So the longer you hold on to it, even if the underlying stock or underlying index futures remain unchanged, you'll find that the warrant value would have decreased because of time decay. However, it's still possible to make money even if you pay time decay, and I'll show you some examples of how you can do that later.
Thanks for that great introduction, as well as covering how this market making works. Now, the next question, you mentioned that Macquarie uses options to hedge. So can investors then use options trade?
And a good pickup of what you were listening to, Olivia. So slide 11. The short answer to your question, Olivia, is no. Warrant investors should not be employing option trading strategies with warrants. Why is that? Because first of all, because of the presence of the market maker or warrant issuer, it means the only person who is able to write an option or the warrant here is the market maker or the issuer, like Macquarie. And as a warrant investor, because you can't write an option or you can't sell an option or warrant, what that means is that you can't do, your straddle strategies, your butterfly strategies, which is very typical of an option trader. Okay, you can't short sell a warrant because in Singapore there are, short selling rules that will make sure you get penalized if you do short sell a warrant. So anyone who short sells a warrant has to cover that short sell position intraday. What we'll recommend generally as a warrant trading or selection process is essentially 4 steps because warrants are meant for short-term directional position taking, meaning if you were bullish, you will buy a call warrant, and if you were bearish, instead of shorting a call warrant, you should be buying a put warrant instead. And the recommended selection process, as I mentioned, is really 4 steps. First of all, you have a target entry and exit level on the shares. And that's something you have to do as part of your option trading strategy anyway. Okay. And you enter and exit on the warrants based on this target entry and exit level on the underlying share of futures, index futures. Okay. Step 2, you must select a holding period or know a time frame for which you're going to hold on to the warrant. Why? Because they're not like shares. They don't last forever. And just like options, they've got an expiry date, and you need to be conscious that, during this period, you are not going to end up losing on the time decay by holding on to the warrant forever whilst the stock is doing nothing. Step 3, you need to be conscious of the gearing effect that both warrants and options offer you. And you need to know that as much as warrants are able to magnify the gains, similarly, if you got your view wrong, you would also be suffering magnified losses. So you need to select a warrant for which the effective gearing you're comfortable with. And I'll dive into that in greater detail later. And lastly, always choose a warrant that is trading on tight spreads because that's the most cost effective for a warrant investor.
So Jamie, after selecting the warrants, and thank you for outlining the process as well, and also sharing those insights. Now, how can an investor, especially the active investor tuning in right now, how will they know, how, like, what is the warrant price? How will it perform? Like, how can they actually gauge that? Are there any particular strategies that they can use for this element?
Right, so we do have a tool known as the Warrant Selector tool on slide 13. And we really crafted this tool to answer, questions, from investors or basically the question you asked, Olivia. How do I know how my warrant will move and what is the price that I can be expecting on the warrant given, a target entry and exit level on the underlying? So how this tool is used is really quite simple. You basically enter the view that you have on the underlying where you think it's going to move to, and then you increase the number of weeks on this tool to see how the warrant price would change with time. Now on slide 14, I've got a demonstration to show you how this tool works. This tool could be found in warrants.com.sg, which is Macquarie's website. It's found under the warrant tools. And you can simply select the warrant selector. Now you choose the underlying of choice, in this case, the Hang Seng. If you're bullish, you click on the call. You enter your target price on Hang Seng, in this case, maybe 17,500, and then you increase the number of weeks on this tool to see how the warrant price would change. In this case, the first warrant here, you see that, by the fourth week, if the Hang Seng moves in your favor for 5.7%, the warrant is going to increase by 50% and more. But as you keep increasing the weeks, you find that by the sixth week, the first warrant that you're looking at on the screen would have made a loss even if your view was correct. This is because the time decay has eroded into the gearing provided by the warrant. So when you're looking at the first warrant, what this means is that you need to set your holding period to a maximum of 5 weeks. And if you're keen to hold for longer, then look for the other warrant that continues to make gains by the 6th week. In this case, the second warrant on the screen you see here continues to generate a return of about 10%, which is still more than, the underlying index futures. If you had traded the futures, directly, it would have gained 5.7%, but you will have gained 9.8% via this warrant still. So you can use this selector tool for any warrant, for any underlying that you're interested in, to know and approximate the maximum number of weeks you can afford to hold on to this warrant, whilst also getting a taste of how the warrant will increase in terms of its percentage gains relative to your view on the underlying. Now, if you're interested to find out exactly, how much this warrant will move by in terms of days rather than weeks, we also have a tool separate from the warrant selector tool to find this out. On slide 16, we've got this tool known as the warrant calculator, and how it differs from the warrant selector tool is that it will tell you and approximate the number of days that the warrant value will decrease by its time decay. And so if you wanted to know in terms of the date that you should be looking out for as the maximum date that you can afford to hold on to the warrant rather than by weeks that the selector tool has demonstrated for you, you can use this tool. Now on slide 17, we will play how the tool works, but essentially it's also found on the warrant tools drop down. In this case, you can find the warrant calculator there. You need to know which warrant you're looking at. In this case, this is a DBS put warrant, okay? And you need to have a look at what the warrant price is at the point that you are looking at the warrant is, in this case, 3.4 cents. But if you were to change the date from today to say, the 22nd of March, it would be unchanged. But on the 23rd of March, you find that the warrant price would now have dropped from 3.4 cents to 3.3 cents. This means that the warrant has decayed over 4 days. And again, if you increase the date from 23rd of March to say around 27th of March, you find that the warrant will have decayed another tick. So essentially, this warrant generally decays one tick for every 4 days. And then this is for the savvy warrant investor who wants to know exactly what the time decay is on this warrant. And it's going to differ from warrant to warrant. So you can use this tool on any other warrant that you're interested in to know how it differs from warrant to warrant, what the time decay approximately is for each of the warrant that you're looking at.
Thanks, Jamie, for that. Now, for those of you who just joined us and you missed that part, don't worry, you always have this replay available for you. I'll share more details at the end of this live show. Next question. Now, do all warrants behave the same way, or do they also move the same way? What are your thoughts, Jamie?
Well, I think what you've seen from the selector and calculator tool, in case you haven't picked it up, especially those who just joined us, is that actually the warrants all do move rather differently, even though they are the warrants covering over the same underlying. For example, we saw the example of the Hang Seng warrants on the selector tool. They're all Hang Seng warrants, they're all core warrants, but they move in different magnitude relative to the underlying they track. Now, there is this indicator known as the delta on slide 19 that specifically measures the responsiveness or the sensitivity of the warrants to the underlying. Now, the delta formula is similar to the delta formula on options, right? Essentially because warrants are a form of option. And so for those who are uninitiated on options, well, delta generally, the mathematical formula for this is that it measures the change of the warrant price relative to the change of the underlying share price or underlying index future that they're tracking. And the extreme cases of delta is that if this worked out to be zero, it's a delta zero warrant. What this means is that even if the underlying moves for, say, $1, okay, the warrant price will not move at all because the delta is zero. Whereas the other extreme example is that if it's got a delta of 100%, what this means is that this warrant will move $1 for every dollar move in the underlying share. Okay, so you've got the extreme examples, and you've got everything in between. So, different warrants have got anything, between a delta of 1 to delta 99. And how you can spot the differences of the delta is on our warrant search tool. It's available on our website, warrants.com.sg, where we list out, this is an image capture you can refer to on the slide. You can see how they differ in delta and sensitivity. Now, generally, the higher the delta, the more sensitive or more responsive the warrant is in dollar terms to the underlying. Okay, delta also generally has another general use, which is indicates the probability of the warrant expiring with value and expiry date. So basically, if you are again looking at the low delta warrant, say something with maybe 0% delta or 15% delta, it generally means that at expiry, this warrant is likely to expire without much of a value. Okay, and so closer to expiry date, you'll find that they're generally just not very responsive to the underlying moves because they have got a very low delta. Another indicator, slide 20, is the indicator known as effective curing. That is another indicator that can tell you how the warrant will move in response to the underlying. Now, with delta, it tells you the dollar move in absolute dollar terms to the underlying. With effective curing, it tells you the percentage move of the warrant relative to the underlying. So now, if you've got warrant with, say, a 10-time effective curing, what this implies is that if the underlying shares or underlying index moves for 1%, you should expect this warrant to move approximately 10 times of it, which is about 10%. Again, that's available on the warrant search table on our website when you're searching for a warrant. And it is available, it's information available right next to delta and sensitivity because they're all related, right? Because it tells you how the warrants will move relative to the underlying. Well, as much as I said that the formula for delta is mathematical, but doesn't mean that you need to calculate it because on slide 22, we have got the live matrix, which tells you how the warrant is moving live relative to underlying. You have, of course, also got the warrant selector tool and the warrant calculator tool for bigger moves that, the underlying is not able to achieve during the day to tell you how approximately how much you can expect the warrant to move and be priced at relative to underlying. Now, to summarize in slide 21, the relationship between delta and effective curing and the warrant price really is this. The higher the delta, the more responsive the warrant will be in absolute dollar terms. However, if you look at the percentage term, it could be less responsive. Why? Because something that's higher delta generally will cost more, okay? And when it costs more, it will offer you lower gearing, right? In terms of the percentage change on the warrant. All else constant compared to a warrant that is priced lower, it will give you a lower percentage gain. And so it therefore has got a lower effective gearing. And one with a low delta, even though it's less responsive in absolute dollar terms, it can generate and it generally should generate a higher percentage return or loss just because of its low absolute price of the warrant. And therefore, it gives you higher gearing, a higher return if your view was right.
Thank you so much, Jamie, for that. And also, I've got some questions coming in already from the live audience. Now, we'll save your questions to be picked at the second half of this live show. Thank you so much for being here with us. Now, next question. So some warrants have higher delta and some with lower deltas. Now, is this the same as warrants being in the money and out of the money? And is there one that's better than the other, Jamie?
Well, Olivia, you're very savvy, terms like in the money and out of the money. Well, maybe you're an option trader, but that is a term that is not unfamiliar to those trading options, right? Where the option is in the money or out the money, at the money. But for those, again, those who are not very clear on that, slide for 24, I just want to quickly go through what this means. Now, I'm using the example of call warrant with the exercise price of $5. And how do we know whether a warrant is in the money or at the money or out the money? Well, in this case, I've got a hypothetical example. First chart bar chart that you're seeing, it's an example of a warrant that is in the money. And why is that? That's because with this call warrant exercise price of $5, the share price is currently above the exercise price. The share price is currently trading at $5.20. So when this call warrant's got exercise price below, it has got an intrinsic value of how much? Of 20 cents, because that is how much the share price is trading above the strike price, right? So it's got a 20%, it's got a 20 cent intrinsic value. And so minimally, such warrants that are in the money with intrinsic value has to cost a minimum of 20 cents or whatever intrinsic value it is. Having said that, the warrant will typically cost more than the intrinsic value because there is the time value component. In this case, it's 5 cents. And so this warrant will cost about 20 and a half cents. And such warrants with intrinsic values are termed in the money warrants. However, not every warrant is in the money because there are various warrants available in the market for different purposes and needs. There are at the money warrants. And how are they at the money? At the money warrants basically are those where the share price currently is at $5, matching the strike price of the warrant. Okay, in this case, it's got no intrinsic value, and so it will cost less. And all it's got is time value. And in this case, at the money warrant will cost about 8 cents, or else costs constant relative to an in the money warrant at 20 and a half cents. Now, you also have warrants that are out of the money, whereby the current share price or the spot price of the share is currently below the strike price of $5. In this case, if the share price was $4.80, that's below the strike price of $5, you'll find that it will cost even less than an at the money and in the money warrant. In this case, it will cost you just 3 cents, and all it's got, just like at the money warrants, is time value. It's got less time value, and it's got no intrinsic value. So amongst the three types of structures, in the money, at the money, and out the money warrants, out of the money warrants generally cost the least, and in the money warrants generally cost the most, or else constant. Slide 25. To draw again the relationship of whether how in the money warrant compares to out of the money warrants, I summarized that for you. In general, you imagine that out of the money warrants will cost less than the in the money warrant, right? Because of the lack of intrinsic value. And what this also means is that they have got lower delta. Now, we've just learned about delta about a minute ago, whereby it measures the responsiveness of the warrant. Now, something that's out of the money is going to be less responsive than something that's in the money with a higher delta. Okay, it's going to be less responsive in absolute dollar terms. It's also got a higher premium. Now, another term for premium is actually known as time value. So it's got higher time value because it doesn't have intrinsic value. So all it's got is time value only, and therefore out of the money warrants generally have got a higher percentage premium compared to in the money warrants. Having said all that, they come with the highest effective gearing. They come with the highest risk. And so if in this case, if your view was correct, you will achieve the highest return with the out the money warrant relative to an in the money warrant because of the higher effective gearing. Slide 26, I've got that all summed up. Your question, Olivia, was, is one structure necessarily better than the others? Because I think at this point, maybe most people will be thinking, actually, in the money warrants sound like the best, right? Because they've got the lowest risk, they've got, intrinsic value, and, it sounds like the safer bet. And indeed, in the money warrants are generally lower risk compared to out the money warrants. But again, it depends also on the expiry of the warrant. Now, if you're pairing it in the money warrant with something that expires, months from now, generally they have the lowest risk, as you can see on this chart. Okay. And on the converse, on the opposite end of the spectrum, if you are someone who is very high risk, you probably want to go for something that's out of the money and that's going to expire very soon, because maybe you are very, very certain and convicted of your view, and you just want to make the quickest amount of money, the highest percentage return within a short period of time. In this case, then you probably want to choose an out of the money warrant rather than in the money warrant, because you don't want to put so much money up front, because in the money warrants cost the most. And you want to basically make sure that you capture the highest percentage gain with the lowest amount of capital that you placed up front. In this case, you probably gravitate towards an out of the money warrant that is a shorter dated. Now, again, to answer your question, is there a better or worse? The answer is no, because again, if you go back to slide 24, if you had bought a warrant that's in the money at this point, what if you got your view wrong? The shares can easily go down from 520 to 480, such that you're now out of the money. And likewise, if your view was spot on and you were correct, even if you have bought an out of the money warrant, as long as the shares go in your favor, that out of the money warrant can quickly become in the money. So again, I go back to your view, whether you're correct, right? And your risk profile on slide 26. What is your risk profile? If you are a lower risk investor, then okay, you can still choose the in the money warrant. But if you're a higher risk investor who's very convicted of your view in the short term, you probably want to choose an out of the money warrant that costs the least and which you can achieve the highest percentage returns with.
Mm-hmm. Thanks, Jamie. Now, why is it that warrants aren't always on at tight spreads? What are your views on this?
Thanks for the question. That's one of the most popular questions that we get on slide 28, that we get. Now, in order to know whether a warrant is on tight or wide spreads, I think going back to one of the tools that we've constructed to answer that question is the Live Matrix tool. It's available on our website, just because it shows you where the market maker quotes are relative to the underlying quotes during the day, and you'll be able to easily tell if you're on tight or wide spreads. Now, slide 29, something that's on tight spreads, typically, if the warrant was priced below 20 cents, would have a 0.1 bid and offer tick spread between them. Okay, so if you look at the screen here, something that's priced at 6.5 cents on the bid and 6.6 cents on the offer. Now that's a warrant on tight spread because it's got the minimum bid and offer spread of 0.1%. However, if the warrant price was really high, so typically maybe in the money warrants, which cost quite a lot more, the minimum bid and offer spread is 0.5 cent. So do take note. If they were on 0.5 cent spread, it's not because they're on widened spreads, but because there is the minimum bid and offer spread of 0.5 cent for something that's priced over 20 cents. Now, going back to most warrants which are priced below 20 cents anyway, how do you recognize they're on widened spreads? You would expect to see that if the bid price was 6.5 cents, the offer price would be higher than 6.6 cents. Okay, and what typically happens when a stock price crashes or comes down within a short period of time is that if it came down from 350 to say 235, two things. One, you'll find that the call warrant will decrease in price from 6.5 cents on the bid to 2.5 cents on the bid. But what you also find is that the call warrant, instead of being priced at 2.6 cents on the offer, is now gone up to 4 cents on the offer. Now, that's certainly more than a 0.1% spread. In fact, there is a 1.5 cent spread. Okay, so that's a 15 tick spread. Why has that happened? The reason is because the delta of this warrant has gone down from 47% to 10% because along with the stock price drop, it's gone down. It's going to be less responsive. But also because, it's likely that this warrant is very short short dated and it's about to expire. So it's, it's a higher risk warrant, which we're trying to tell the investor as a market maker to avoid this warrant. So instead of, offering it at 2.6 cents, where it's a tight spread, we're now raising the offer price whilst keeping the bid price unchanged and fair to holders. And we're raising to the offer price to deter people from buying more of this warrant. So what happens if you're an investor, existing investor, who bought this warrant at 6.5 cents and now it's dropped to 2.5 cents on the bid, and you're wanting to average down, you're wanting to accumulate more of it because you want to bring down the average cost of the warrant. Now, one way you can do this is that you look into another warrant available, and there will be better warrants available over this underlying that's gone down, and you average down or you buy into the warrant via that new warrant instead. Okay. Buy into this warrant at 4 cents is not a good move because it's not cost effective at all. But don't worry, because if you still want to stay invested via this warrant, the bid price is kept fair. Okay, it's going to continue to move according to the delta. It's going to respond according to the underlying, according to its delta. And you can freely exit from this warrant and look into another warrant. But otherwise, you can hold on to this warrant. But generally, the strategy is, you probably would want to cut loss on this warrant and roll into another warrant instead, so that you can maintain the exposure to this stock, whilst seeing this warrant move and respond, in a more responsive manner to the stock, because the delta would be higher than, the current 10% delta that you see in this warrant instead. Now, slide 30, which other circumstances would you typically find that warrant market makers are on wide spreads? Now, I think, first of all, we have to be very clear. We very much want to keep tight spreads on all our warrants. Why? Because we're in the business of selling warrants. We want to keep it tight spreads so that it's cost effective for you, so that you can easily get in and out and have a good trading experience with that warrant. However, there are instances where we just can't keep tight spreads. Why? Because typically they are very short dated. And very high risk. They typically have less than 2 weeks to expiry. And it's our way to tell investors to stay away from such warrants. Because if you're not dialing into a webinar like that, I have no way to tell you this warrant is very high risk and not great, for you to invest in. And we can only show it via our spreads. So we widen spreads for those that we're not keen to sell, to warn investors against that. Well, it could also be an instance where we are close to selling out or we have sold out on the warrant. And that recently happened last month in one of our DBS put warrants, for example. And typically in those instances, we will put out an announcement on our Telegram channel and our Facebook channels to warn investors that this is happening and to look into another warrant which we have still got inventory to sell to you. And the third example is, like I said, it's very far off the money. It's got a very low delta, where the delta has crashed from, whatever it was to something very low, typically less than 15% or 10%. In those cases, again, to warn investors, we typically widen that on the offer. And finally, sometimes the stock itself, the futures itself, is just too wide. There is no liquidity there. And because remember, we hedge when you buy or sell warrants, we can't provide the tight spreads for an extended period of time if the underlying stock of futures is just wide, for a long, long time. But I would say that, that an example of this happening is far and few. Typically doesn't happen for a very liquid index like the Nikkei, the US indices, Simsky, Hang Seng Tech, etc. And likewise in a stock like DBS or Tencent or Alibaba, you frequently do not find that the stocks are so wide and illiquid. So for those warrants, we typically find us on very tight spreads.
Keep those questions coming, everyone. I see a lot of questions coming in from the audience members. Now, keep them coming because I'll pick the best ones for the second half of our live webinar. Next question, now that we know about warrants and we're thinking of investing in them, right? Coming from the investor perspective, especially those tuning in, do you have a recommendation on the investment amount, Jamie?
Well, I can't, I think slide 32. Well, I think, first of all, I can't advise on how much one should invest because that really depends on your own risk profile, and how much capital you are willing to use to invest in any product at all. So I think I would generally say investors need to ascertain that. But I would say that I have a good indicator to help you, benchmark your investments in warrants relative to the underlying shares. Now with warrants, you essentially can do two things. You can, hope to profit when the underlying goes up by buying a call warrant. But likewise, you can also profit and make gains in a falling market when you buy a put warrant, right? Because that increases in price when the underlying comes off. Now, if you were looking to say, for example, then hedge, against a falling market because you've got a portfolio of, say, shares. We're entering into earnings season, Olivia, in China. So this week, for example, you are seeing a lot of, Chinese companies report. And if you're a bit nervous about, how the earnings report could turn out and the negative impact it could have on the shares, what you could do is you look into your investment in your portfolio of that share, whether it's, a portfolio of, say, different shares like Tencent and Alibaba, or if you were purely invested in, say, Tencent shares alone, and you wanted to hedge against, any potential pullback in the share price in the short term, you can then consider a put warrant. And how much you would be investing in the put warrant in turn can be estimated with the effective gearing level that is available over each warrant that you're looking at. So in this example here, we've got S&P put warrant, of course. Not quite a 10-cent put warrant, but it could very well be a 10-cent put warrant. In this case, if you look up on our website the effective gearing levels, like I said, on the warrant search tool, you'll find that the effective gearing on such a put warrant is 12.8 times. Now, what this means is that if you're looking to hedge again your portfolio of 10-cent shares of, say, 100,000, you need only to invest 12.8 times less in this put warrant if you're looking to hedge with this put warrant. And that will equate to around less than $8,000 investment to hedge your $100,000 worth of shares. Now, to find out how many of such warrants you should be buying, simply use this investment amount of, say, 7,800 divided by the offer price or the ask price of the offer of the warrant, and then you will get around about 156,000 of this warrant. And you know that therefore you can go into a Moomoo platform and type 156,000 of this warrant to buy in order to hedge against, your portfolio of Tencent shares ahead of its earnings result. I think tomorrow, in fact. So that's something you can do. Again, this can apply to any underlying you're looking at. If you're looking at, say, going long because you're very bullish on, say, DBS, and you think it's going up in the short term, but at the same time you need to extract some investment dollars from your current portfolio of DBS shares because maybe you need to pay a deposit on your house, your new place, but you want to remain very bullish on DBS. What you can then do is, if you're withdrawing about $100,000, from, your portfolio of DBS shares, you can remain vested in the upward move, the bullish move of DBS by buying a call warrant. And again, you use the same method by looking at the effective gearing of this call warrant. If it was 12.8 times, it means you invest after extracting $100,000, to put in your property deposit, you can still use $7,800 and buy into this warrant to be equally exposed as you would with $100,000 worth of portfolio shares to the movement of DBS shares in the short term.
Thanks for that. And final question to wrap up our fireside chat before we take the live audience questions. Noting that the warrants have an expiry date, what happens then, Jamie? And what can they look forward to next to get started?
Yes, so every warrant has got an expiry date. It's like for 34. And I guess, a common misconception that I've heard investors say is that they think that they have to hold the warrant to expiry date whenever they buy a warrant. But again, if you have attended this webinar, I hope you now know that with warrants, they're just like shares. You enter and exit based on your target levels of the underlying. And that's why that's the number one strategy we tell warrant investors. enter and exit based on your entry and exit levels of the underlying. You don't have to hold on to the expiry, but of course, there are some people who hold on to it to expiry date, and typically those are the investors who unfortunately did not achieve the target exit levels of that they were looking to exit at. Basically because they got their view wrong, because they were intending to get out of the S&P at 5,002, but the S&P has pulled back to 4,009, so they've ended up holding onto their call warrant, and sitting on unrealized loss. Now, I would say you're free to do that, but of course, a better strategy is to adopt a cut loss strategy. But if you wanted to hold to the expiry, you can. Just note that the expiry date, the time value of all warrants becomes 0. So if your warrant was not in the money, okay, it was at the money or off the money, you will have 0 dollars in terms of settlement value. You will not get anything back. At the same time, the last trading date of all warrants, so the last day to get out of it is 5 business days before, because they stopped trading 4 business days before the expiry date. So if you had no intention to hold it at the expiry date, please note that the last day of exiting from any warrant is actually the 5th business day. You don't have to memorize this date because it's all available on our website when you're looking at the warrants, each warrant alongside the deltas, alongside the sensitivity, alongside effective gearing levels, etc. There is the last trading date that's being shown on our warrant search tool. Now, at expiry date, in order to determine if they've got value and whether they're in the money or not, we basically essentially take an average closing price of the underlying shares 5 days before the expiry date to ascertain if it had value. If it was an index warrant, say S&P warrant, Hang Seng warrant, etc., the settlement level is determined based on the settlement level of the futures that expires during the month. And so again, if it was below the strike for a call warrant, then it's going to be out of money or at the money, and you are getting nothing back at expiry date. Okay, but even if you're getting something back at the expiry date, typically this will be less than what you see on the last trading date, because the time value component would have gone to 0 on expiry date. So that's something to note for those who intend to hold it to expiry date. But otherwise, please feel free to trade in and out of the warrant way before its expiry date.
Sounds great. Thank you so much, Jamie, for that. And also great insights there. Also sharing from the perspective of Macquarie. And of course, we've got some questions coming in. So we'll be back with you shortly, Jamie, because I want to show them quickly how they can access this on the Moomoo app. See you shortly, Jamie.
See you.
So everyone following through with me, you've heard the analysis, you've heard the closer dive into warrants, especially for Singapore. Now, how can you apply this on the app? So very, very quickly, just open your phones, follow through with me, and you'll see over here, if you click on markets, okay? Markets tab, you see the overview. We're gonna go to Singapore. So under Singapore, very quickly, you can see right here, it's right there, warrants with the symbol. Just click on that and you'll see the available warrants for you on the app. Now you can filter for yourself, okay, depending on what you've learned from Jamie's presentation today, but then you can also adjust the price and the percentage changes right here, okay? So for those of you who want to flip your phone to the other way, you can see the full details as well, but it works perfectly in this format. And all you have to do is just go to the interface and really interact with it to really suit your own needs, okay? So let's say for Macquarie, of course, for the purpose of today, we're going to use one of their warrants. Now, warrants issued by Macquarie has MB in it, okay? So if you want to just go through, we're just going to quickly click on it very randomly. You can see right here the full details of it, okay? So this is just the overview chart, but you can see the activities are updated in real time and it actually changes according to the updates, right? So all the data is here for you, access for you. Anything you need, you can access it for yourselves and customize it according to what you're looking at that particular moment, okay? So here you got the capital trend, you got the trade overview. If you want to find out what it's all about and get more information in the description, especially the ones that just joined us, I know some of you are new to this topic, definitely check out the previous live webinar that we had on Warrants 101 if you want to know the basics, okay? But you can also click on the information icon. I know it's kind of small, but it's next to the term that you want to check out. And you can get all the in-depth information from that. You just scroll down to your right, you go to comments, you can see what is being said about this particular warrant. You've got KOLs and the influences in the particular in-app communities, but you've also got all our experts who also have their own pages, right, that you can follow through with. And you can also click on news for any relevant news related to this particular warrant. Okay, so definitely play around with it, adjust it. Now, if you want to heart this and keep this on your watch list, it's quite simple. The heart icon on the top right, you just have to click on that and you can add it to your watch list. Now, I have a question about the replay of this. No worries. You can go to Discover, go to Moo. You can see right here, I've been interacting with you guys, but this is where you can watch the replay right after the show concludes to really catch up on what Jamie shared before. Now, definitely give us a thumbs up or a yes, ready to move on to Q&A right now in the chat box. I want to see some action and energy from our audience members tuning in. Now, keep those questions coming, okay? We're not at the end yet. Now, let's invite Jamie back into the room for the live Q&A. Welcome back, Jamie.
Thanks, Olivia. Yes, please ask me anything, because I think the best way to know about a product really is to ask questions about it. And the best way to get good at a product is to ask questions so that you know the ins and outs of it. So please ask me anything.
Absolutely. First question for you. Warrants good for a long-term investor like myself?
Well, the answer is no, because warrants are really designed for short-term trading only. How short-term are we talking about? Well, typically you find that our warrants, the longest dated, actually expires at the end of the year, for example. So that's just a 9-month warrant. And for a long-term investor, that is a very short period of time, right? So warrants are really designed, especially with, the time decay feature as part of the holding costs. They're really designed for investors who have a short-term view of the market. So I would say typically investors literally sometimes have only an intraday view. They have a 1-day view. Some have got like a 1-month, 2-month view and are still able to make money via the product. In fact, some of the top performing underlines such as Capital Corp and Semcom Industries, the top performer on the SCI, for example, those, even if you held onto the warrant for about 9 months, you could continue to generate returns via the warrants, right? Because the stocks have moved about basically 30% over the last 9 months, such that even with holding costs, with time decay, the gearing of the warrant has enabled the warrant investor to make money. But I would say typically warrant investors, they do have a time frame of no more than 3 months. And of course, the longer you want to hold onto it, the more the underlying has to move in your favor in order for you to make the magnified returns that will more than compensate, for the time decay. Now, is that too short? Well, I guess the question is, what kind of market do you think this is going to be? If you think that this is going to be the kind of market where there's going to be a lot of volatility, and I like to give the example of the Hang Seng, where if you're a long-term investor, you probably will be sitting on a loss just because over the last 3 years, the market has come down so much. But if you were a short-term investor, you're looking at it with a time frame of maybe a week or a month, you could still potentially make money because, there is that 1,000 point volatility, that's the 500 point volatility that allows you to get in and out of the position via an instrument such as warrants. So in short, warrants are not meant for long-term investors. I like to say if you have got a view of, typically 6 months or more. So for example, if you think DBS is going to $40, please don't buy a warrant. But if you think DBS is going to $40, in a month's time or in 3 months' time, then I guess a warrant could be suited for you because you can then use the warrant to capitalize on the short-term move in underlying. But if you've got a 1 year trading horizon, you've got 9-month trading horizon, please directly buy the shares because you are better off buying the shares and making money via that rather than warrants. But if you think the market's going to be very volatile in the short term, like I said, you think it's going to make a big move, whether on the upside or on the downside, and that if that's the case, then you could probably want to consider a warrant to fully capitalize on that, because if you're seeing from the examples, the warrants tend to move in magnified terms relative to underlying shares. So even if you had made 10% in say DBS in the short term, with a warrant, with the right direction and right call, you could make 40%, 50% and more.
Thank you. Next question. What are the risks in short selling warrants, and are the risks similar to options?
Well, the risk of short selling a warrant is that, if you don't cover that during the day, you are subject to the SGX, buy-in, which forces you to cover that position in the buy market on 2 days later, right? T+2. So with options, you can freely obviously short sell because you are able to sell a warrant and earn premium, basically time decay, right? From the one who is buying from you. But with warrants, you can't do that. You are basically long only. Either you buy the call because you're bullish in the short term, or you buy the put because you're bearish in the short term. So, we generally discourage people from short selling in case they end up short selling for the day and, are subject to the buy-in. But if you want to continue doing that, for example, you love, shorting a call warrant rather than buying a put warrant intraday, just make sure that you cover the short sell position by buying back the warrant at hopefully a lower price from where you sold it, in order to make a gain on the short sell position.
Mm-hmm. Thank you. Next question. Are we allowed to roll structured warrants?
Well, I do hope that question has already been answered in the previous slide when I talked about how some warrants, when they drop in the delta because the share price has basically tumbled in the short term, and this warrant is typically very close to expiry. Generally, you see that Macquarie would have widened the offer spreads to discourage people from buying more. So one way of rolling the position, right, is by cutting your losses in this warrant and buying a warrant that expires, at a later date, but also one that's on a tight spreads, typically with a higher delta. So that's one way you can roll. Now, if you're thinking, if I bought an index warrant and I have to roll it because you're thinking with futures, you have to roll when you buy futures, the answer is that you don't have to do that with warrants because we are rolling the futures on our end. But at any point in time, where the warrants are tracking the front month futures contract. So I'll give you an example. Right now, we are currently tracking the June futures for Nikkei and US index warrants. Why? Because the futures would have expired for both US as well as Nikkei contracts, right? So if you're trading March Nikkei futures as well as March US index futures, you have to roll it. But with warrants, you don't have to. If you had bought a warrant that expires in March, it would have simply expired. But if you had bought a warrant over the US or the Nikkei that expires in September, there's nothing you have to do. You need only to know that you are now then tracking, the June futures, and the warrants will move in accordance to the June futures rather than the March futures. I hope that answers your question. If you're looking at something that like a Hang Seng or a Hang Seng Tech or a Simsky, well, those contracts that they are tracking basically follows the roll of the futures, whereby as we head towards the end of the month, rather than looking at the March futures, if let's say now we're on the 26th of March, you will typically be the warrants will be following the April futures instead, because we are rolling the futures position on our hand, which we're using to hedge. So there's nothing you have to worry about rolling if you're thinking in terms of futures expiry.
Thank you so much for that. Now, someone would like to know the difference between warrants and DLCs, for example, and because earlier we covered the differences with options. So this time for DLCs, what's the difference? And also, when or how can I determine which one I should use for that time period?
Okay, that's a good question. And typically, sometimes I do have the slide for that, but in this case, I don't because I didn't expect that. But it's a very good question. Thanks for asking that. Now, DLCs are also a form of listed leverage product that's listed on SGX. Essentially, SGX are offering three types of listed leverage instruments, warrants being one of them, DLCs being the other, and then of course there's structured certs. But basically, what all three products do essentially is to offer investors a short-term product whereby they can obtain leverage or gearing relative to the underlying move. So again, they are mainly suited for short-term investors, not for those who have like a 9-month, 1-year view. And I think I could safely say that for all instruments, because if you're dialing into a DLC webinar, they would tell you the same. But how we differ really is in terms of the features. So for example, with warrants, we don't have an airbag feature. What that means is that if the underlying comes off by 15% during the day, and that tends to happen a lot with Hong Kong stocks actually, or they come down by 20%, 25%, whichever is the percentage amount that triggers the airbag feature. It doesn't happen with warrants, even if it stayed down and finished down on the day for 20%. Typically, what you find for DLC is that the airbag mechanism gets triggered, it gets delisted, and the DLC goes to zero. But with warrants, because there's no airbag feature, basically what you're going to see is that the warrant, if it was call warrant, it's going to fall by the magnified amount, the geared amount. But if the stock rebounded the next day by another 15% or 20%, it clawed back all of the losses that it made the day before. You typically find that then this warrant has got hope of going back up again, and for you to exit from the warrant. So I think that's one of the differences. Now, all all listed leverage instruments listed on SGX or not, right? They can be listed on other exchanges. They basically all have holding costs, but we differ in the way we define them. So with DLCs, they've got they've got other costs that they're listed, that they have listed on their website. But for ours, our holding cost is I guess in a way less straightforward, because they're known as time decay, and it increases with time, and it depends on what kind of warrant you're looking at. Basically, time decay, is can be very steep with a warrant that's going to expire soon versus a warrant that's going to expire in 6 months' time. But to circumvent that confusion or that difficulty of estimating what the time decay is, we therefore introduce tools such as the calculator and the selector, so that warrant investors can be more acutely aware of what the holding cost is when they trade the product.
Thank you for that. And thank you everyone for your great questions, especially Jamie for answering pretty much both the fundamental questions, but also the extender questions from your insights shared before. Now, for those of you who want to see the replay, don't worry, it's available after this, okay? Because I got a few questions on that. Now, Jamie, what is your final takeaway for our audience members today on the topic of a closer look as we dive deeper into Singapore warrants?
Well, I just want to say, if, whatever we've covered today, it was in-depth enough for you to better understand warrants, I'm glad. But I also hope that this means that you are able to, it will translate into a higher success rate with warrants. And if that's the case, or if you're completely new to it, I do hope that you use the chance, now that you're armed with knowledge, to try out this product. And as far as I know, at Moomoo right now, you stand to win up to $400 if you are trying warrants for the first time. So I hope you do make use of that, but also try it only because you have attended this webinar, you've watched a replay, and now you are a bit more self-educated from before you attended this webinar in terms of how you can better use warrants to leverage off your views of the market in the short term. And I hope you make lots of money with this product known as warrants, because that's the only way you can come back to this product, and for us to continue to be out here to sell you the product. Ultimately we hope that you make money, and it can be a win-win situation. Like I've said in this webinar, it can be a win-win situation because we're hedged in the market, but we've also we've got ways of making money via margins captured, via time decay, etc. So we do hope that you make money via the gearing offered from warrants, and we will also make money, and then we can have this win-win relationship via warrants.
Win-win relationship. I love that. Thank you so much, Jamie. That was head of Singapore Warrants, Jamie Chung from Macquarie, everyone. See you for our next show together, Jamie. Thank you so much for being on here.
Thank you very much for your time.
To the audience, if you have any more questions, definitely put it down in the chat box. We always monitor it and want to see what you want to see next as we keep track of your own needs and also your investment topics, especially related to warrants. So drop the comments down below. And if you enjoyed this part 2, type in yes in the chat box so that we can keep this going. Okay, we love the energy today and also the conversations that we had on the show. And as always, we're here to guide you in your personal investment journey. So definitely stay tuned for more of these shows. So you can follow our QR codes right here in app and also on our social media pages, especially for the replay of today. So scan these codes so that you know where to get the next show and also to watch more topics that are similar to this. And as Jamie mentioned, here are the details of the warrant special. Scan for more if you want to check this out for yourself. And the promotion actually runs until the 31st. So definitely check this out before it ends. And as always, it was a pleasure having everyone here with us today. It's almost the midweek. I hope you have a great week ahead, and we'll see you for the next show. Once again, I'm Olivia Higgins.